quickly about me, I work as Vice President at BlackSoil. I fund startups across the sectors and stages. We are 2,500 crore AUM fund. Our ticket sizes usually go up to 100 odd crores. Some of the notable investments that we've made is Jiva, Bluestone, we've been in Euler. So we are on the debt front. I have two stalwarts. One is who is representing investor side and one who has been the founder for more than 15 years. Would love to deep dive into their experience and see, some insights that we can get from both of them. I'll just request some more introduction from you guys to give the audience some perspective about your journey and more about Liqvd Asia before we, deep into the discussions.
Pleasure to be here. Just to give you a short introduction about myself, I co-head the private wealth business for Motilal Oswal. I have been on the managing side or wealth management side of the business for over 2.5 decades. Spent a large part of my journey at Kotak, where I set up the ultra HNI vertical. So have been dealing with large family offices, large clients. Have actually seen the entire evolution of how investing has changed from where we started to where we are today. So yeah, we'll be very happy to discuss my journey of how I've seen this change.
Absolutely.
Session.
Thank you so much, Krushant. Thank you so much for introducing. My name is Arnab Mitra, as it says. And currently I run a business called Liqvd Asia. It's one of the premier digital marketing ideas first agencies of the country today. We also have last year acquired another company called AdLift, and we kind of merged the entity. Entrepreneurs don't talk about their background, but let me do that. I started my career with British Telecom in London, and then swiftly moved working with some of the large group agencies like Havas. I was the regional director, and Publicis, I was managing director for India. I was also the first guy to get a Cannes Lion for digital marketing for the country back in 2011. So yeah, and then that gave me the courage to start my businesses. So thanks for having me.
Incredible. I'll start from the source of capital first. That's the main raw powder required for a company. Akash, you've been managing family offices for over 2 decades now. You've seen family offices' investment thesis evolve over a period of time. Earlier, they were more about preservation of the capital, where they used to invest into safe assets like real estate, gold, listed equities. Now we've seen a lot of participation from family offices into startups. They've become LPs into various funds, maybe VC, PE, or private credit funds. What has fundamentally led to this shift and change of the investment thesis? Is it a normal change, or is it a conscious effort by the family offices?
See, the biggest driver of this change is that India has changed. When I started my wealth management journey way back in 2004, the starting point check that I used to take from a client was 50 lakh of rupees, and that was large. When I built the ultra HNI vertical for Kotak, the starting point check I used to ask was 50 crore rupees. Today, the number of people with 3 digits or 4 digits across areas in the country which you can't even imagine. I'm not exaggerating. I take 4 to 6 flights a week into cities which I would have never thought that I would be going anytime, because the kind of money that is, the kind of pool that has come in, it's unbelievable. As you rightly said, 2 decades ago, the avenues of investments were real estate, listed equities, their own businesses. Today, the avenues of investments have grown far beyond that. You have private companies driving far more value. By the time they reach the listed markets, a lot of the value creation has already happened. So that is one change that people have seen. The biggest proof of the pudding is people have seen this change happen. They've seen success stories that have happened in companies. You've seen Nykaa, you've seen Policy Bazaar, you've seen Lenskart. You've actually seen multiple such instances where you've seen this value drive happen from when actually a private investor invested by the time the company reached public markets and what the value creation would be. The second part of it is generational. Today, the next gen which has come into the business or come into the family businesses, they have been used to technology. They are more open to investing into tech companies, fintechs, etc. Their propensity to that sector compared to their forefathers who invested only into their own businesses or invested into real estate or gold. So that is a huge change. The third change that we've seen is the kind of managers who have come in. right? You have access to great PE managers, great VC managers, and you've seen the kind of companies that they've invested. The proof of the pudding is what you have seen. The fourth change that I have seen is families now don't manage money. See, when we started off as wealth managers, we used to actually go and distribute a product. Today, the sum of money has become so large that the entire journey of wealth management is institutionalized.
Yeah.
You have a formal IPS in place. You have a proper risk matrix in place. Alternate investments is a part of your strategic allocation. It's not just a one-off investment that you're doing. So I guess all these changes that have happened are the core reason for this. It's not a cyclical change. It's a structural change that you've actually seen happening in the industry or in the pattern of investing.
Just to add on that, I mean, more power or more capital gives them more options to invest, right? Most of the family office which are now exploring investments into alternative segments, the first of the question that they arise or they are in dilemma is whether should I go directly, invest directly into the private limited companies or go through and leave it to the experts and maybe become an LPs to a PEVC fund or a credit fund. If a family office here right now is evaluating this question, how would you advise them? Should they approach directly or should they are better off leaving it to the experts?
So, see, the first question that I ask any investor, you want to build a good bouquet of companies to make a fruitful portfolio and not just a talking point that I invested in A, B, or C. What people see are only the winners. You're seeing one Zerodha, you're seeing one Nykaa, you're seeing a Policy Bazaar, but behind every one success, there are 25 companies that have failed, right? So do I have the ecosystem to A, the deal flow? How do I get the deal flow? B, how do I do the due diligence? How do I have the governance in play? Do I have a follow-up? Is my capital good enough for the company to give me access to information which I would actually require to keep reviewing the company? Do I have the ability to keep pumping in money? At what stage have I come in? Because companies will keep requiring capital till they actually hit the markets or they've matured in size. So I don't think everybody has all these characteristics to actually do that or have the expertise in their entire ecosystem to actually get that done. The better way of doing it is invest. Today you have world-class VCs, private equity managers available to us, and they've shown success, right? If you choose the right manager and you cut a sizable check, you can actually have an opportunity to co-invest with them into a particular company, because based on the size of the fund, there is a certain amount that you can actually write a check to a particular company. There's always room for some more. So if your check size is decent enough in the share class that you are in, you get a co-investment opportunity. Yeah. You would rather pick and choose, and probably more than just trying to make a return out of that investment. Probably if that company is of interest to you or you have some value add that you can do, you're not just cutting a check, but you're actually adding value to that company by partnering with them.
Allowing them to do much more than just providing a capital.
So it's not, each investor is different. Where are we? If it's an extremely large family office, naturally you have all the infrastructure built in to get the right deal flow, to do a proper due diligence, to do a proper governance, to add value. So it is all, the best part is if anybody is starting up, start being an LP and then progress to it.
Maybe co-investment is the best option for them to do that.
Absolutely.
Arnab, for you, it's a complete different journey together. You have completely skipped the PEVC route and, you've directly gone for applying for an SME IPO, after being bootstrapped for more than almost 15 years. Just wanted to understand your journey. Was this a conscious decision for you, or have you contemplated raising equity from VC players or something else?
Yeah, so the long and short of it is that it is a conscious decision for us to stay away from the VC money, and the real reason behind is we wanted to pace out the way, or as an entrepreneur, how I wanted to build the company. Bootstrap has its own challenges and own advantages, right? I was coming out from my last job was second largest advertising agencies doing maybe about $1 billion at that point in time, 2010, 2011. From that to an office where I literally had to also sweep the bathroom because a client was coming to visit, and that day the office boy didn't come. So it was the massive shift. But services companies have not really been quote unquote darlings of VCs, right? And I kind of took it to our advantage, and we wanted to build it up because I think we were very sure that before we even accept any money, we wanted to build a business that does not require the money, right? And that was very, very important, right? Including last year the acquisition that we did. So we are a 13-year-old company. We acquired a company which is 16-year-old, right? We acquired a company that got 2x number of people that we have, right? And the reason we could do it because I think we built a business which is solid when it comes to the bottom line, and that was something I learned the hard way, or maybe the best way, because I was working for others, and so it's by choice. Having said that, I mean, I don't necessarily frown upon the ecosystem where VCs come in, but I genuinely think that we're still to see patient money in this market, and I'm still to see VCs who don't have herd mentality, who are really, really patient when it comes to investing in businesses, that truly require capital and, be there. I mean, people keep on saying that India doesn't have the mettle of building the OpenAIs and the Googles of the world. I'm saying that we don't have the VCs who can even fund OpenAI. Like today, you got to know about OpenAI in 2023, but it started the company 2015, right? So who funded him then? Who funded Sam Altman 8 years back before it even started? And it's not even profitable as yet. So I think we were very sure that we didn't want somebody running on our back and pushing us for revenue and bottom line without really building a business which can deliver the scale of business that we want to do.
The problem you are mentioning, maybe Akash can solve this for us. VCs can only fund for a larger tenor when they get money from LPs for a larger tenor. We were just discussing in the last panel that in India, maybe we have not seen a patient capital where LPs want an exit, maybe let's say 5 years, 6 years is also big in Indian market compared to in US where 15 years is still a normal thing, right? Do you think that sort of mentality coming from family offices where they are open to deploy for more than 15 years to in PVC funds, or that is still a long way for India to go?
See, the biggest change that you are seeing is, and I keep saying it, National Stock Exchange. Okay, I mean, it's not a startup, but the first check that was cut by another investor apart from Government of India was in 2005. I used to work at Kotak, and Kotak, we had a private equity fund which actually had participated, and 5% of the fund. So I've been speaking about the NSE liquidity IPO journey for the last 21 years. And it's now finally, hopefully, going to happen, right? Yeah. There was a period of time after the financial crisis for 7 years, there was no exit for NSE. There was not a single trade of NSE that actually took place. Till in 2018, when Radhakishan Damani actually came in and people said that, oh wow, there is family offices also where the institutional investors which had invested through the fund route who could get an exit, right? So people, and people have seen, though you saw people getting irritated on because there was no liquidity. Yeah. Today, even if it's not listed, it's a T+1 trade. But there was a period for 7-8 years where you did not get liquidity in NSE. People have gone through that journey and they've actually seen their money compound in the bargain. So I guess that patient capital is coming back, that education to people is coming back. Earlier, it was private investments was not a part of a core portfolio. Now it's a part of a core portfolio. So when I'm advising any client to build a portfolio, we tell them 80 to 85% of the portfolio needs to be liquid. 10 to 15% of the portfolio can be liquid, and that is illiquid up to, if God forbid a situation like this happens where 7 years, 10 years, 15 years, there's no liquidity event that actually happens in that company, you need to be prepared for it. The second change that has happened is naturally the sums of money have increased dramatically. Yeah. Even if you want to spend it in this generation or the next generation, you can't spend it, right? So propensity to risk or holding capacity has increased dramatically because you're actually seeing, I mean, every single day there is a new OFS or a strategic sale that is happening, which is going into high 3 digits or even medium 4 digits. You could not think of these kind of numbers till some time back. So that money flow has to come into other avenues apart from listed equities or traditional debt, because from a tax advantage that doesn't make sense. And people have actually, the proof of the pudding is you've actually seen success.
Yeah.
So that is.
On that point, we've seen some report from EY Julius where it mentions that still after the fundamental shift and new money coming into the PE VCs, only less than 20% of the allocation is happening from a family office into alternative segment.
Yeah.
Right? It's not more than that. And also, only 57% of the family office are still investing into it. So if the more dry powder comes into this ecosystem, and the percentage also keeps increasing, what is that Indian startup ecosystem has to do to achieve that? I mean, is there something that we as an entrepreneur or as a startup ecosystem have to do that maybe companies like them who can give a good exit are those companies which can come in, maybe that can increase the percentage of proportion that a family office can give allocate to alternative investments?
See, the biggest proof of the pudding is liquidity, right? So the recency bias always plays in. So if you are actually seeing liquidity events happening by way of IPOs or strategic sales, automatically the confidence level of people increasing that allocation towards this asset class or this particular medium of investing increases dramatically. So the first point is that luckily we are actually seeing it. We've seen series of successes in the recent past, which have actually advocated that yes, there is an investment which, if I hold on for 5 years, 7 years, 10 years, it is giving me my fruitful returns. Because today, what is actually happening is what we are seeing in the index is not actually giving you a true picture of what exactly is happening in the markets. So when you say Bharat and India, there's actually Bharat and India happening in the markets. Yeah. Your index is still filled with 26% banks, IT, non-AI IT. You have manufacturing companies. But what you don't have in the index is the growth companies which are actually growing. They're not profitable as yet, or some of them are profitable, but they're actually growing at 25, 30, 40%. That is going to lead the next, because today capital will chase growth. Yeah. Right? The valuation will the price will catch up to valuation or vice versa. But definitely if you're showing growth, money will move there. So people need to see the growth. People need to see exits. People need to be educated by people like us to tell them that this is capital which you will have to be patient, whether it can happen in 2 years, but it can happen in 5, it can happen in 10. But you need to be patient. So you need to invest only into a particular private company if you actually believe in the founder, if you actually believe in the sector, you are interested in the sector, then only put money. Because don't put this money just for the sake that, oh, you're going to multiply, or somebody said, oh, private markets give you a 18 to 20% return, listed markets give you a 12 to 13% return. Don't go by that. Okay. Invest into companies which you believe will be the next phase of growth for India. I'll give you a living example, what happened with us. We as a house are extremely confident and bullish on the quick commerce space. We were investors in Eternal, earlier Zomato. We still hold it in our asset management portfolios. We were pre-investors in Swiggy, and we've taken a sizable allocation to Zepto. Okay. Right? So we believe that this is a sector which is here to stay. This is a sector which is here to grow, because the total audience which is going to be using that particular service is just going to expand. Today, I don't think any of us sitting in this room or their families are not using any quick commerce service. I mean, today, if I forget my charger and really need it, in 10 minutes I can get it. I don't need to go to the Apple store and pick up a charger or an AirPod or anything at any hour in the morning. So I'm just saying, today times have changed. You will invest into companies or sectors which you believe in, and you'll ride it. So when people were investing into Zepto and we collected an extremely large amount there, we actually told investors, naturally, whichever investor came in was somebody who had a 4-digit investable surplus because of the size of the check that he was cutting. And we told every investor that don't invest into this company as a pop-up gain, because we don't know, because at the time when investors came into Zepto, there was a lot of regulatory changes that were happening in the company. There was NCLT approvals required. There was a lot of noise happening around it. We said, if you believe in this sector, and if you believe that this sector is here to stay, and you believe in this kid who was at that point of time 22 years old, if you believe in him, then bet on it for the next 5 or 10 years. I'm extremely confident whoever has come in is going to make a 20-25% compounding return on it. So that is so you need to believe in it. I could go wrong, or my investor's thesis could go wrong, but that is the reason why you would do
belief
it.
is important. Taking to your point of times have changed. Arnab, you have started and been bootstrapped in 2013-14, right? Now the time has changed, right? Do you think startups, founders currently who are building it up, there is still possible for them to continue as bootstrapped? Because the world is changing rapidly in 2-3 years, right? You never know 4 years back that AI will change everything, right? Today, how everyone operates has changed because in 4 years, AI has come in. As a founder, someone will think, if I don't take VC money, am I going to lose out on that curve? Maybe I'll not grow fast enough. In 4 years, the market will only change it, or maybe some competitor who is raising in VC money might just overrun me. So how do you solve that problem for new founders who are coming today?
No, I think it's a very pertinent question. Sometimes, everybody possibly know here, going to the market is a very difficult choice, because you have to go through a series of work which you are not technically capable or technically sound enough to do. And we learn that before going to the market. So of course, we also keep on asking ourselves that, are we skipping a step which we could have taken and maybe grown the business to a sizable business than what it is today? Do it. So, but I think the answer lies in the kind of business you are in, and not so much on the model per se, right? Every model is correct, as long as, like, nothing succeeds like success. Every model is correct as long as you can give good returns to the investors, like you mentioned. So I think founder to founder, the decision has to be that what kind of business I'm in, or my business is in, and after that you decide that what kind of money you want to choose. Because some businesses, my personal opinion, honestly, and this is, I don't know if too many people are going to agree to this, I genuinely think that first 3 years you shouldn't pick up anybody's money, because it is extremely important that you build things up the hard way, like really put yourself, like, I love this line called where rubber meets the road. I think you should put yourself to that. That grind is extremely important. Have your back touch the wall. Prepare yourself to not get a salary. It is easier for younger generation because they're not used to a salary. But when I started it, which is about around 30 years, I was already used to getting a SMS on the first morning on my mobile phone. And that was the biggest thing that, I kept on missing for a period of time after that. So I think that you should put yourself, one should put oneself for at least 2 to 3 years time without any investment from anybody, and try and see if you genuinely have a model. Because in our tech world, we have this word called MVP, which is the minimum viable product. And a minimum viable product has to make money. Yeah. And when that, and then compound it, because scale is a very different conversation. And it's a choice. Sometimes we also come across as clients who tells us that, okay, this year my budget is going to be 100, 150 crore, 200 crore, right? And there are clients who would say, okay, my budget is not so much. I don't know if you can afford a company like Liqvd Asia, and we would discuss. And when we go to them and we understand this, that in both these cases, there is a significant amount of scale difference. But if I keep the revenue out of it, what is extremely important is to know that finally is this the economy of scale that I'm going after, or I'm actually genuinely making money if I kind of break it down to the unit method. So, and I think nothing teaches you best if it's your own money, because if it's your own money, you are going to count that more than anybody else's, right?
That's an interesting perspective. Right now, we have seen VC funds who are just investing in the stage of idea as well. Right. And there has been a contradictory, advice from you that don't raise capital for 3 years. That's a hard path to follow, I believe, for most of the founders here. I'll just quickly check in case anyone from the audience would want to check. I have few questions more, but just quickly check in case anyone of the audience would want to maybe perhaps ask any questions. No. I'll take it further then. Arnab, so you've applied for an SME IPO, right? Any advice for founders who would want to directly go to this route like you? How easy it's been to go to an IPO directly, being an SME IPO as well, right? So is it something, would you do it rather yourself again, given you are starting up right now?
So, I think last question and this question to me is pretty similar, because I think we are doing it after we have achieved a certain kind of scale, right? Currently we are running about a 300 people company, right? Which is handling, if I just talk about, every kind of business that we do, maybe 1,000 crore plus, business. Now that's a I would say an okay scale, for a company like, advertising, because the largest of the advertising agencies would be about 10 or 15,000 crore in the country. So we are somewhere in that, scheme of things. But if we were, just a startup, we just started right now, I don't think that's even a scale when you should consider getting money. Like, that's my opinion on your last question. But having said that, why we chose this path of going to the listing right now is because I think our business is now ready to become answerable. And I think that is the main important thing that I have at least learned. I am not from the finance industry. I come from a tech marketing background. But I think over a period of time, we got seasoned to know that we can answer questions. We are responsible enough to handle capital in a way which only focus towards growth. Because see, nobody is ready to give me money to make me rich, right? Everybody is giving me money to drive growth for their money. So we need to know where to really invest. I genuinely think it's very difficult at a very early stage, as an entrepreneur to do it. If it's a 2x founder or a 3x founder, maybe they already know it. But if you're starting for the first time, I would say that that's not the way. But having said that, the capital market choice is entirely a function that whether you believe that your business is responsible enough to handle that kind of pressure. Because like you said, is it easy? To me, it isn't. Because that's not our main business. For them, probably they do it day in, day out. But for us, we are used to helping people do digital transformation, make their businesses, something that people like. But we didn't know how to really raise money. So it's pretty difficult. So my suggestion is, till you don't want to do it and you're, absolutely don't want to ride that, not even a horse, it's actually a leopard. And you don't want to ride the leopard, don't do it.
Awesome. That's interesting. Last question to Akash. We were speaking about family office, right? There have been valuations, corrections, and profitability is the key now. What are family offices looking at it? Are they still looking at MOIC, or are DPIs more important? When they are evaluating between funds, what are the key criteria that now family offices have changed, how their lens have changed too while deploying into some of the PEVC funds?
So naturally, the biggest driver of investing into any fund is choosing the right manager, right? That's the biggest success mantra, is if you get the right manager. It's a discretionary play. So naturally, an investor or an LP doesn't have a say in where the manager is selecting. So choosing the right manager is extremely important. And then the valuation game to co-invest, that comes in whether at the particular value that the fund is investing in, do I want to double up my bet or no? So those questions come in later, but at the time of investing, the main point is choosing the right manager. And the good part for India is that you've seen multiple such managers and you've seen success stories. I mean, our own fund, the first fund that MO had launched on the private equity side was $150 million fund, which was 18 years back. We just closed 6 months back. We closed $1 billion fund, which it took us just 2 months to correct. So, and that the only reason is because you saw successful investing styles over the last 4 funds that they had invested in. So I think manager selection becomes absolutely key. I don't think an LP has a say in what valuation that the fund manager is investing in.
Awesome. This is really helpful. Thank you so much for your insights. It's great to know an investor perspective and also a founder perspective. Thank you. Appreciate your time, guys. Thank you.